Hey guys, welcome back to another weekly webinar, and I am super excited, and I hope some of you guys are as well, for today's topic. Today, we're going to be talking about building a winning system through backtesting. Now, I've been talking about this the last few weeks. Together, we spent a lot of time just going over risk management, talking about trading styles, trailing stops, momentum trading. We've talked about a lot in the last month, and this today, in my opinion, is probably one of the most important presentations that I could put together for whether you're new or even experienced. This might be a great refresher or a great eye opener to actually building a strategy start to finish through backtesting. There's a lot here to cover, so I'm going to be flipping through slides. Remember that there will be a recording available for you to go back if you want to go back and spend more time on any particular subject. You're welcome to grab that, and we'll have that thanks to Eightcap for you afterwards. Just a reminder, if you're new to these webinars, if this is your first time experiencing one of them, Eightcap is awesome for doing them. They host a guest analyst, a professional from a different part of the industry. I'm really honored to be here with you guys this month, and of course, hopefully you get some sort of value out of it, and I'm sure that you'll have another great analyst coming next time, so it'll be awesome. So let's take a look. Building a winning trading system. So here's the thing. Every trader is unique. Different traders use different systems, right? Everybody approaches and looks at the market in a different way. And that can be really important to notice because, again, you might go around on YouTube and stuff and you might see somebody using a strategy and it's working really well for them. But then when you try to use something like that, you're like, I just don't resonate with it. I don't like holding on to these trades. I don't like the entry style. I don't like the exit style. It just doesn't suit you. Something has to be comfortable to you. If you don't have a system and a trading plan, it is almost inevitable in this stuff that you're going to lose money. No magic, no losses are going to be inevitable, and you're going to have to work hard to actually become profitable, even if you do spend the time backtesting. It's not an easy stuff, quick step. So let's talk about winning systems. Good winning systems, at least by my definition, have a plan for the following things: entries, exits, and indicators that they may use. Risk management model, extensive backtesting behind them, stress testing behind them, which we'll talk about later on, and forward testing, as well as evaluation. Constant re-evaluation of strategies that you're employing is actually important, and we're going to talk about that here. So sit tight, stick around with me, and we'll continue to go through this. So first, let's talk about entries, exits, and indicators. So clearly, this is where a lot of people, this is the most exciting thing to newer traders, is like, show me how to enter. What indicators do I use? What's the price action secrets? How do I, grab liquidity? There's like a million different ways, things that people like to use to enter and exit the market. And in my opinion, they're a bit overhyped, right? The entry style is like what everybody wants to talk about. They are important, don't get me wrong, but it's not the only thing, as you'll see in this presentation. There are thousands of technical and fundamental indicators out there, and some technical analysis examples that you guys, I'm sure, are relatively familiar with are things like the RSI, the relative strength index, moving averages, the average true range, price action, etc. And then, as well as fundamentals, we could take a look at things like interest rates, unemployment, earnings reports, which is especially relevant to right now. The earnings reports in the US have been pretty good, at least showing some signs of life in the stock market area. If you've noticed, like US 30 is up, NAS 100 up, that's off of right now. The story is pretty decent earnings. So anyways, as we get going, there's so many different things for us to look at. So I don't want you to get overwhelmed by that. I want you to understand, okay, there are thousands of indicators, so we need a rule set to approach, a scientific method, if you will, to approach this stuff, to actually build strategies and test them before putting live money on the line. So with entries and exits, we're worried about two things, right? Where do we get in and where do we get out? That's like the simplest question. It's like the new trader 101. The first thing they ask is, well, how do I know when to buy? Or how do I know when to sell, right? With all these indicators, how do we know which ones to follow? Is there a magical one that I should be following and ignore the rest? So on and so forth. It comes down to doing the hard work, which is testing. It doesn't matter which set of indicators you use, you should test them to see what, you want those answers not from someone else, but from your own empirical testing, right? Your own strategy development testing. So markets change day to day. This is another thing. If you were trading in 2019, it was a very different market environment than 2020 and onwards. Volatility has expanded dramatically over the last 2 years, and it's a very different market environment. So different markets have different personalities, and some things tend to trend more, other things tend to trade in ranges more, going back and forth, and sometimes they change. So we have to be adaptive, and we have to understand that with testing, we have to understand the market that we're playing in, because each one has a personality. Here's oil, for example. This is a chart from 2020, and you can see that in 2020, oil just crashed, right? As markets were fearful that essentially the lockdown periods would completely kill the demand for oil, which they did in that period of time prior to another massive trend upwards since then. By the way, we'll talk about that in a moment. Oil has been trending to the downside. But what about the dollar Swiss during this time? Dollar Swiss, despite some major swings, still has maintained a relatively choppy style of trading. It goes back and forth a lot, probably due to the fact that both of these tend to be risk-off currencies and they tend to range against one another. It's not always the case. Sometimes that changes, but it's an observation that we could go test, right? And this is what it's all about, taking your observations and taking, the scientific method approach, if you will. Entries, exits, and indicators will keep going. So most strategies fall under one of two categories. And this is, if you want a simple reasoning why one strategy doesn't work all the time, it's because usually a strategy works in one environment, but not so much in the other. Meaning that in a trend following environment, if you were to simply just follow moving averages, you're going to do great. But in a mean reverting or range bound market, moving averages are going to be your worst nightmare, because as soon as it starts trending, that's actually the top of the range, right? So this is where an indicator like a Bollinger Band will work incredibly well in a mean reversion environment where the markets are just going back and forth. That's like the easiest entry signal ever. It breaks out and comes back in, bam, you're buying or selling. But again, these things are not all encompassing. The markets change, the dynamics change, and you have to be adaptive to a degree. So trend following is simply defined for me as going with the dominant direction of a market. And counterintuitively, mean reversion is the opposite, looking for stretched markets and trading them back to fair value, right? So think about if a price gets very far away from a moving average and you buy or sell it in anticipation for it to return to that point. Trend following and mean reversion both have their pros and cons. Neither is clearly better than the other. And this is where people, they have these mantras that they get from online where they think like, oh, we'll always do this or always do that, right? Trend following strategies work great in breakouts, pullbacks, and continuation favoring markets, whereas mean reversion strategies, they do great in range bound markets. So whichever you choose, pick some indicators and start testing, which brings us to kind of our next concept here. So let's say we have a simple example of a theory. Euro dollar has been heavily range bound in the last few months. I will try to use a standard Bollinger Band strategy to trade the high and low extremes. And this is what I want you guys, because our call here is going to end. But what I hope is that when it does end, you're left with this line of thought process where you're thinking, asking yourself the questions that if you have an opinion, ask yourself that question. Okay, now go test it, right? So euro dollar has been heavily range bound. I'll try to buy and sell the extremes on a moving average or on a Bollinger Band. So the idea is buy if price closes outside of the lower Bollinger Band and then is followed by a close back inside. And sell if price closes outside of the upper Bollinger Band, then is followed by a close back inside. Exit if price touches the middle Bollinger Band, which is going to be the default 20-period simple moving average. And this, I'm not telling you this is like, oh, this is the magical strategy. This is an example. This is something that you could then go test, because a strategy is more complex, when you add more variables and things like that. But anyways, the theory here is that price has been back and forth in euro dollar, and I think this could bring some decent results. So this is where the back testing comes in. Again, so once you've identified your entry idea, your hypothesis, if you will, then it's time to actually go collect some data. And so, for example, let's see our strategy in visual form. Price breaks out, closes back in, sell. Sold it back to this moving average, that resulted in 70 pips. Price closes outside and closes back inside, we buy 97 pips of profit. Here's another one. Closed outside, closed back inside, buy 111 pips. Closed outside, bought on the retest or as it entered into the market, closed here for 58 pips. Hopefully what you're seeing here is that this strategy works really well in this example. But hold your horses. Not so bad. It gained a few hundred pips, but it's not enough. Why is it not enough? This, you guys, right here, this to anybody who's interested in stats, mathematics, which I'm interested in them. I'm not great at them, but I really appreciate statistics and stuff as a trader. And anything, anybody can probably see that, if you drew an entire conclusion off of this 1, 2, 3, 4, 5 examples that you see on the screen, sure, if that was your entire sample data, that's not enough, right? 5 trades is not enough to tell you if this strategy truly wins or not. You need really 500 to 1,000 theoretical trades over 2 to 3 years plus of data. And in fact, the more data that you collect and more test examples that you collect, the more confident you can be historically in what your back test looks like. So here's an example of one that went poorly wrong. So if we were to conclude, oh, this looks great, right? Every time it closes outside and closes back inside, we sell or buy and we make money. Beautiful. Looks great, solid, let's go with it. That's what many traders will do. They'll jump into the markets after that and say, can't possibly lose money. And then this happens, right? This is the scenario where, okay, it closes outside and closes back in on these 2 candles. So we buy just like our rules said to do. We're just looking for a move right here. It's just a quick moving average retest and we'll make some profits, right? Well, look what happened. It trended. Now the market changed from a range-bound market into a trending market, and it resulted in a single trade just based on our simple rules of 481 pips lost, right? And you see the problem here is you can't jump to conclusions based off of just a few trades in your test. You need a lot. And so if you were to test a concept, you need basically, the truth is, whip out your Excel sheets, or if you're a programmer, you can play around in MQL4, the programming language to program your strategies, etc. But you basically need to get your data out and start testing extensively. So have your idea, write your idea out, and then go throw it against the markets and test, right? You can go on TradingView, MT4, whatever you want to use, and just go back in time and start testing your ideas. So successful trading strategies require testing. Testing is not fun, and it's not meant to be, right? Nothing about successful trading is meant to be like just an overjoyous, always fun, printing money environment. That's what it's sold to you as, but ask any real trader and they know that that is completely unrealistic. It's the only way to get an idea of the performance of a strategy. Test historical data before you put money on the line. Now, of course, let me offer a disclaimer here. Testing something historically does not guarantee it's going to be profitable in the future anyways. The one thing that if you stick around in markets long enough, you will find is that there is no guarantee of anything in financial markets. Not a single thing is guaranteed, except for the exception of the occasional losers and losing streaks. So anyways, here's the thing, right? With back testing, once we have our ideas, once we start testing the concept, we basically can whip out a spreadsheet. You can also do it by hand if you prefer. I've done many sessions where I get a piece of paper out, or pen and paper, and just start writing down results 1, results 2, results 3, and getting an idea of how that performance looked. You can basically scroll back on your chart 1+ year, depending on what time frame you're using. If you're using a daily chart, you might want to go 10 years back. If you're using a 1-hour chart, you might want to go 1 year back, right? Go bar by bar, testing your strategy on setups that occur. Now, I like to use the replay function on tradingview.com because what it does, it allows me to put myself into a trade without seeing what's going to happen next, right? One common mistake, and I believe we talked about it later on, is if I'm looking at this thing and I can see what's going to happen next, it can impact my opinion on what I'm going to do. But if I can't see it, then I'm going to trade it as if it was real. So like if my idea was to take a buy trade and I can't see what's going to happen next, right? That's important because then it doesn't allow you to make that back testing mistake where you fudge your own numbers because just because you see something, right? So when you're back testing, I like to use the replay function on TradingView. There's plenty of other options out there as well. So let's go back to our slideshow here and we will continue. So backtesting will give you a decent idea of how your strategy has performed historically, but we're not done. Backtesting doesn't guarantee anything. Avoid the optimized strategy that looks too good to be true on paper. Because here's the thing, what a lot of times people will do is they'll get into their testing and they'll tweak something until it works perfectly. And that's what's called optimization. And it works in many things in life. like maybe like factory, like let's think of like a manufacturing plant. They might optimize the time of certain things, or the time of day. They might optimize that when it's reliably consistent data, but there's nothing super reliably consistent about the markets. The markets change all the time. So when you try and optimize a strategy, meaning you use the 11 period moving average instead of the 10, right? When you start trying to tweak it really hard to make it work perfectly, the problem is you're doing that on historically what worked perfectly, but may not perfectly work in the future. So this doesn't always work well going forward. So this is where we need the next step, which is forward testing. Once you have done some back testing and you're feeling relatively confident with your tests, now it's time to forward test, which brings us to our next section. Forward testing is basically you grab a demo account and you start disciplining yourself to actually spend the time, the weeks, the months, however long it takes you, to try out your strategy in real time, taking hypothetical trades, demo account trades, to test out your ideas and your concepts that you've seen perform well in your back testing, assumingly, right? So if you've seen a good back test and you're like, okay, well, let's see how it does going forward without putting any risk on my account. You'll find out how well you execute your strategy doing this, which is important in a minute by minute real-time environment. How do you perform, you as a trader, placing your trades, finding your strategies, or setting up your trades, etc. And you're going to make mistakes and learn, and this is why you don't want to use it on a real account just yet. Again, most traders, they do not do this process. They jump right into live markets as soon as they feel half decent about a strategy, and then they are left wondering why they're not making money when they haven't done the work, right? So demo accounts, why they don't help, right? A lot of times you'll hear people say like, oh, well, demo accounts, they don't help because there's no real money on the line and there's no thing. My opinion is that's kind of not true. And here's why. Sure, there's no money online, but your time is on the line. What about your time, right? If you're spending all this time and effort building strategies, and then you're demo testing to prove a methodology that you've worked so hard to test, that's your time on the line. And what's the old saying? Time is money, right? So even if you're not risking real money on your trades, you're risking your time and your efforts and you as a person, what you could be doing instead. So that's the thing, right? So you do have, of course, something on the line. And also, if you're only ever interested or stimulated by the money in trading, it's the wrong industry for you, because this stuff is meant for people who are really interested in markets and willing to learn about them extensively. That's the people who the only people I know who are consistently profitable have a passion and a love for markets. They're really interested in this stuff. So once you've got a demo account set up, it's time to trade. Take theoretical trades when you arise. Perhaps you could try risking 1 to 2% of the account. You may want to risk more or less. That's up to you and your strategy. But this is just how, when I go through a testing process, that's how I'll start. Risk 1% per trade. Track your performance in a spreadsheet. Test for as long as you possibly can, really, but at least a few weeks. You should not be in a rush to do this. At the end of your trial period, it's time to evaluate your strategy. Let's say you test it, you try it in real time for 1 full month, and then you say, okay, let's evaluate your strategy, right? So first, take a look at the number of wins versus the number of losses. What was your win percentage, right? So you could just divide wins over the total number of trades. So if you won 6 trades out of 10, that would be a 60% win rate. 15 out of 25, 60% win rate, same concept, right? So next, we need to look at the average reward relative to the risk. So how many dollars did you make for every dollar you risked? If you risk, $100, are you making 200? Are you making 150? Are you making 50? These are questions you have to ask. So know your risk to reward ratio, right? Because even if you have a low win rate but a high risk to reward ratio, that can be still a profitable strategy. The big question is, does your forward testing look similar to your back testing? This is important. If yes, this is great. Maybe it's time to test on a small account. So this is sort of exiting the loop, if you will, to a degree, because now you're saying your forward testing has started to look a lot like your back testing. That's what you want, right? You want your back test, let's say it's producing 3% per month, and then you start forward testing and you're able to start producing 3% per month on average. Hey, it's matching the back testing. That's good, and definitely a step of confidence in the right direction. If it's not, it's time to go back to the drawing board and see what's missing, right? And this is the key thing here, right? This is frustrating, but oftentimes this is the case where you have to go back and you tweak something, redraw the strategy up a little bit, find something that works a little bit better, maybe switch markets that you're testing and go forward from there. Now I want to talk about stress testing, and this is the hidden part of the bell curve that traders sometimes ignore. Stress testing is trying on purpose to break your own strategy to see how easy or hard it is to do. Finding examples of the worst drawdowns that your account would have experienced historically. So every strategy goes through tough times, drawdowns, and losing streaks. It's inevitable. It's guaranteed. Trend trading strategies suffer during range-bound markets. We discussed this earlier. And reversal strategies suffer during markets where the trend is really strong. The question is, how will your strategy do in the worst case scenarios? If you're range-bound and the market starts trending for 3 months, did you survive? The question is, did your account maintain integrity? And what you'll find, if you just a little tip of advice for people who've been doing this for a very long time, if you're relatively experienced like myself, what this forced me to do over thousands of hours of testing concepts is to reduce the position size. This is going to be your key, which we'll talk about a little bit in a second. To test this, I like to go find the account blowing culprit, if you will. So this is where you're basically digging through your own data, through the markets, finding the toughest examples that you can find on the charts that you plan on trading this system and see how the strategy performed. So it's like our example for Euro USD. What was that worst case scenario, right? Where that trend just took off to the downside and we were caught in a long trade. We need to know what that worst case scenario looks like. Here's a stress testing example. Let's say you're a breakout trader and you're experiencing this, right? And again, this is important to look straight in the face of. If you're a breakout trader and you're taking several losing streaks because the markets are range bound, there's no 100% way to tell if a market's going to continue to break out or continue to range bound. So we have to look at the worst case scenarios and measure up our performance relative to that example. So in this case, let's say you're looking for breakouts and you just experienced several losses, right? This is where you have to be very honest with your strategy and your ability. Many traders will, during a stress testing, they won't like the fact that I'm not going to be able to make 15% per month because it results in the periodical blow up of the account. You have to be honest with yourself here and realize that, of course, we've talked about this with our risk management concept as well. Trading is not a quick way to make money. The stats do not make sense to try and make money. The markets are not that predictable. There are some great strategies out there, but nothing is surefire all the time, which is what you would need to make money all the time really easily. Anyways, you have to be honest with yourself. Do not cherry pick. This is the devil's nectar, if you will, is cherry picking and ignoring the terrible case scenarios, right? I wouldn't have actually taken these trades because I would have known this, right? You know, you can tell yourself you wouldn't have done something, but you can't do that when you're truly testing your concepts. You have to look straight in the face of the worst case scenarios and ask yourself, would I have survived if I took all these trades? If it fits your trading plan, count them. That's the key, right? Risk management, we discussed this a lot last week, but we'll do a quick recap for people who have missed this. So in my opinion, this is the most important component to long-term sustainability of a trading system. Trading systems that last decades have to have the most rigid and tight risk management models. Proper risk management is your seatbelt, essentially. It doesn't stop you from potentially getting into a terrible car wreck, which, you know, this is a pretty dire example, but it's, you know, when it comes to trading, you know, it's good to be a little bit on the extreme side of examples. It's your seatbelt. It doesn't guarantee you're going to be perfectly fine, but it does help to keep you safe. Controlling drawdown and market exposure relies on this concept. So how do we manage risk? Well, there's many ways, but small conservative position sizing, as we spoke last week about, avoiding high leverage, a realistic expectation of gains, focusing on drawdown first, a back-tested expectation of normal drawdowns, right? We're expecting drawdowns to occur. It's okay, but as long as they're, you know, our risk is managed, that will keep us in the game, right? Having the proper capital requirements is, of course, key as well. So keeping your trade size really small, so you can risk really small per trade. That's one way that keeps you, you know, in the worst case scenarios, it keeps you from getting anywhere near blowing an account, right? And if you're not using a stop loss, maybe a max drawdown is something you consider. We discussed that last week as well. Of course, stop loss for new traders, I personally think that they're a great idea. Of course, not everyone loves to, there's different styles and different strategies. So if you don't have a stop loss, at least consider what you're going to do if the market just completely goes against you. How are you going to handle that, right? So you have to have those concepts in mind. So when it comes to this stuff, right, some common pitfalls that a lot of new traders fall into with back testing and strategies is, I'll give you guys a little bit of an example. When I first started really back testing, I was in college and I spent a lot of time wanting to come up with a trading strategy that could allow me to produce something like 20% per month. In my mind, that was attainable. In my mind, that was reasonable when I first started really looking at trading seriously. I was actually mentally really, really bummed out when I realized after many, many hours of backtesting, I couldn't find a strategy that got me anywhere near 20% per month without consistently blowing up somewhere along the line. So let me show you guys something. I'm just going to, hopefully you guys can see my drawing here. Take a look at this. What I would be able to do is I would build strategies that would produce hundreds of percents, right? Really quick, like it would produce like 300%. But then in one trade, it would go to zero, right? The issue here with trying to create strategies where you make like 20% per month, right, is that if we talk about these worst case scenarios, they're going to come, you just don't know when, right? Sometimes the market's just going to start ranging, and if you're a breakout trader, you're just going to have to sit there and deal with that. So you never know when that's going to happen. And in an environment, let me show you guys. So like, let's say this is some pitfalls, right? Let's say we're looking at like gold and you are a trend trader, right? So if you're a trend trader and you're making lots of great gains during this time, you're going to very easily be able to say, oh, 10, 20% per month, that's really easy. But then let's say you use the exact same strategy and same entries, same methods, everything's the same, but the market decides to go into a range-bound market. And during this time, you keep catching losses and very quickly you're down 80% on your account because you were risking big to make that 20% per month. You don't get to make 20% per month in the markets without risking big. And if you risk big, it's only a matter of time before the markets slap you down. So what I found, just in my personal experience, is I kept shrinking my expectations on the market. I became, that wisdom came from all the back testing, all the live trading, everything that I'd done, shrinking my expectations for what I could consistently do lower and lower and lower until I realized that profitable traders, they shoot for very easy to attain low goals, and they just do that consistently for years and compound accounts that way. The goal shouldn't be to make 25% next month. That's a fool's dream. You're doing fool's gold, right? It's fool's gold. Real trading is very slow and steady. It's just trying to go for a couple percent here, a couple percent there. And I get a lot of I get a lot of flack on my personal YouTube channel. If you look up Trader Nick, you can find me there. On my personal channel, I talk about this, and you would think like, wow, that's that's pretty honest, and I am being as honest as I possibly can. I've spent thousands of hours in this stuff, but that usually is responded with on my channel really negatively. People don't like to hear that, but in my opinion, that might just be why most traders fail. They hear words like that and they're like, no, Nick, you're wrong. But I'm like, I've spent a better part of my life dedicated to this stuff. I've spoken with thousands of profitable traders. I've spoken with hedge fund managers, and the profitable ones are on the same page. Risk as small as you possibly can and go for very realistic small gains, and you will likely be profitable sooner. Okay, that is genuinely what I can leave you guys with when it comes to back testing. With your back testing, I promise you spend enough time and you're honest enough in your back testing, you'll realize going for 25, 30% per month, it is likely to blow accounts. But if you shrink your expectations, spend the time testing, spend the time forward testing, spend the time stress testing, all of these things we discussed, it's going to get you one step closer to actually becoming profitable, even if that means slow and steady gains rather than trying to go for big, all of a sudden gains. I hope this session has been helpful to you. I really enjoyed speaking through this with you. And if you're new to these webinars, you can always find me on my personal YouTube channel, Trader Nick. You can just search me up on YouTube and find me there. I appreciate you guys joining me today. I hope you got a lot out of this session. And remember, it will be recorded for you to check back later in case you'd like to go back and listen through a component once again. So thank you very much for tuning in. Have a great rest of your day. Trade safe, and we'll see you back next time.